Hi, my name is Richard Brown from Brown Paraplanning. Welcome to today's video. In today's video, I'm going to share just a few tips regarding dealing with a non-resident client. This area can be quite complex, as you can expect. So once again, I urge you to seek professional advice because all personal circumstances can be quite different, and this is a very specialised area. So today, I'm just going to give you a few general tips on things to look out for, perhaps. The clients situation I want to share with you today revolves around an Australian citizens, not tax residents. They're tax residents of the US, from Australia, and moved to the US for work a fair few years ago. They have property assets in Australia, share assets in Australia, considerable share portfolio. They have shares in the US, property in the US where they live, and they also have a 401k program, which is the equivalent of our superannuation. They also have some small superannuation assets in Australia as well. Now, as I said, I'd like to share a few general tips with you to look out for. The first thing is to say, don't be frightened off by a non-resident coming to you seeking advice. There are people that specialise in this area that can give you some assistance on some tax issues, and there could be quite a good opportunity there in the non-resident space. Now, the first thing I'd like to point out, and you may not be aware of this, is that because these clients had a substantial share portfolio, the first thing I wanted to look at for them is to whether this was in the Australian taxing net or the US taxing net. Now, what I mean by that is that where does the capital gain potentially lie? Now, if you leave the country and become a non-resident, you can elect, without selling your shares, you can elect to be assessed on the capital gain at the date of exit, with the date that you're intending to become a non-resident. Now, this could be significant. For example, if you had a cost base on a share portfolio of $500,000 and you had an unrealised capital gain of only, say, $100,000, you may or may not want to be assessed on that on an upfront basis, that $100,000, thereby eliminating future capital gain from the Australian taxing net whilst you're a non-resident. Now, using that as an example, in this particular client's case, the accountant in question didn't or wasn't familiar with those provisions, and the client is still assessed in Australia for any potential capital gains on the shares. Whereas when they left, which happened to coincide with a low point in the market, the capital gain that could have been included in their tax return on leaving would have been relatively small. Now that gain has lifted considerably. What happens when you become a resident again for Australian tax purposes? So, using the example, you a cost base of a portfolio of $500,000. It's unrealised capital gain quite small. You'll pay your tax on that, and let's say that was $100,000. So your market value portfolio would say $600,000. And then by the time you come back into Australia as a resident, the portfolio might be worth $1 million, for example. That $1 million becomes your new cost base when you come back into the country. So effectively, you haven't been assessed on $400,000 worth of capital gain whilst you've been a non-resident. Something to consider and to think through when you're looking at the assets of a client that is about to become a non-resident. As I said, these clients have some property assets in Australia, some shares, some cash and some superannuation. Just like to share a couple of points with you here. The franked dividends paid by Australian companies, as we know, carry an imputation credit, franking credit, to tax paid at 30 cents on the dollar. So there is no further top-up tax from that from an Australian perspective. The unfranked dividends, there is withholding tax applied to those at the rate of 15%. And with interest earned in Australia, there is a tax rate of 10%, withholding tax. Now, in terms of rental income, obviously there's no withholding taxes on rental income, less expenses, but what happens there, as a non-resident, you lodge a tax return in Australia and you'll be taxed at non-resident tax rates. Now they're currently up to 32.5% from $1. So just in summary, if you've got franked dividends, no further tax because the company tax is 30. The unfranked dividends, withholding 15, interest 10% withholding, and on net property income you'd be taxed at 32.5%. Now, to put this in light, that income that's generated from an Australian resident, this is a general rule, would be also assessed in the US, and you would be given a tax credit for any tax paid or foreign taxes paid. That's the general approach where Australia has got a tax treaty with that other country. So you would pay your withholding taxes in Australia and any appropriate taxes. You would then include that income in the US as income, and you get a credit for the Australian taxes paid. Now, having summarised a few issues there for you already regarding potential capital gains, bringing forward the taxing point when you leave the country, the tax on dividends and interest and rental income, there was a planning opportunity here I saw that to potentially move some of the Australian assets into superannuation. Why would I do that? Well, a couple of reasons. It takes it out of the withholding space because the super funds aren't taxed on a withholding basis, and it also means that that income generated by the super fund falls outside the US taxing net as well. So we have a situation where this client has got a couple of $1 million outside of the superannuation environment. If we could slowly drip those funds into the superannuation environment, there's going to be a massive benefit there in that the super funds, as you know, are taxed on their income at 15%. With all the franking credits, that's going to be a lot lower than 15%, which is a lot lower than the withholding taxes or the non-resident taxes moving forward. So, and the other point is what we decided to do is to make a concessional contribution. A non-resident can still make a concessional contribution against dividend income, interest income and rental income, as we know, up to $25,000. So just by doing those adjustments, we've saved the client somewhere in the range of $3,000 to $4,000 a year in local taxes and top-up taxes in the US, just by shifting some of the funds to superannuation. Now, check your own advice, but I've been informed that we can still take advantage of the $150 non-concessional contribution every year and up to $450 in advance by putting those funds, moving them into the super fund, and also for the concessional contribution, we can still take advantage of that as well. Obviously, you've got to keep in mind that any capital gains tax issues in shifting the assets across, so you've got to be careful of that and do your calculations accurately. So there were some savings there from an ongoing perspective. Now, the big savings, as we both know, is that once these clients reach age 60 or older and are retired, they can then access the income or the drawings from their superannuation fund tax-free. Now, that's providing they come back to Australia and become residents of Australia, which is their intention, and you can only work with what's known fact right now. Is that if they come back to Australia in 7 or 8 years' time, they've got all these funds tax-free waiting for them in their superannuation fund. So just a couple of little pointers today on issues to look out for in terms of non-residents. And I hope you found it useful, and it just, for your own benefit, it's just a trigger point, you know, to say, well, now I know there'd be an issue with potential capital gains, there's a withholding tax issues and so on. Definitely seek advice, but at least you're aware that there are some issues and there's some value that you can add in this space. My name is Richard Brown. Thanks for tuning in today, and I look forward to catching up with you soon. Bye for now.